Gold has long been regarded as one of the most reliable stores of value in human history. For centuries, it has been used as money, a symbol of wealth, and a hedge against uncertainty. Even in today's modern financial system, gold continues to play a crucial role in global markets. One of the strongest factors influencing gold prices is market fear and inflation trends. Whenever uncertainty rises or purchasing power declines, investors naturally turn to gold for protection, making it one of the most trusted safe haven assets in the world. When inflation accelerates, central banks often struggle to control rising prices without damaging economic growth. In such situations, uncertainty increases and confidence in currencies weakens. Investors respond by shifting their capital from cash and bonds into gold, which tends to maintain its value over long periods. This increased demand pushes gold prices higher. Historically, major inflationary periods have often coincided with strong gold performance, reinforcing its reputation as a reliable store of value. Market uncertainty also plays a critical role in gold price movements. While currencies depend on the strength of governments and central banks, gold holds intrinsic value that is recognized worldwide. This makes it especially attractive during periods when trust in financial institutions or government policies weakens. When confidence declines, gold becomes a financial shelter. Interest rates also have a strong influence on gold prices. When interest rates are low, holding gold becomes more attractive because the opportunity cost of owning it is minimal. Gold does not generate interest or dividends, so when interest rates are high, investors may prefer bonds or savings accounts that offer returns. However, when interest rates are low or negative, gold becomes more appealing as it preserves value without losing purchasing power. On the other hand, when central banks raise interest rates to combat inflation, gold prices may come under pressure. Higher interest rates strengthen the currency and make interest-bearing investments more attractive. As a result, some investors move away from gold, leading to a decline in its price. This is why gold often performs best during periods of rising inflation combined with low or stable interest rates. Currency strength is another important factor affecting gold prices. Since gold is priced globally in US dollars, the value of the dollar has a direct impact on gold prices. When the dollar weakens, gold becomes cheaper for investors using other currencies, increasing demand and driving prices up. Conversely, when the dollar strengthens, gold becomes more expensive internationally, which can reduce demand and put downward pressure on prices. Gold also serves as a hedge against long-term economic instability. Governments around the world continue to increase debt levels to support economic growth and manage crises. High debt often leads to currency depreciation over time, either through inflation or monetary expansion. Investors who are concerned about the long-term value of paper money often allocate part of their portfolio to gold as insurance against financial mismanagement and economic uncertainty. Geopolitical risks further strengthen gold's appeal. Wars, trade conflicts, political instability, and international tensions can disrupt global markets and weaken investor confidence. During such times, gold often experiences strong price increases as investors seek stability. This pattern has been observed repeatedly throughout history, from global conflicts to modern financial crises. For long-term investors, gold is often seen as a wealth preservation tool rather than a high-growth investment. It helps balance portfolios by reducing overall risk. When stock markets perform poorly, gold often performs well, providing protection against losses. This diversification benefit makes gold an essential component of many investment strategies, especially during uncertain economic cycles. However, gold is not without its limitations. It does not generate income, and its price can remain stagnant for long periods during times of economic stability and low inflation. Investors who expect quick profits may be disappointed if gold prices move slowly or decline due to rising interest rates or strong economic growth. Therefore, timing and investment goals play a critical role in deciding whether to buy or sell gold. In conclusion, gold prices strongly reflect market fear and inflation trends. When inflation rises, currencies weaken, or global uncertainty increases, gold becomes a preferred asset for investors seeking safety and stability. Its ability to preserve wealth, hedge against inflation, and provide protection during economic turmoil makes it a valuable long-term investment. However, gold prices can face downward pressure when inflation slows, interest rates rise, or economic confidence returns. Understanding these dynamics helps investors make informed decisions about when to buy, hold, or sell gold based on their financial goals and market conditions. When it comes to gold investment, one of the most important factors to consider is your investment goal. Whether you should buy or sell gold largely depends on whether you are a long-term investor seeking stability or a short-term trader looking for profit from price movements. Gold behaves differently from stocks or cryptocurrencies, and understanding its role in your financial strategy is essential for making smart decisions. For long-term investors, gold is widely regarded as a reliable hedge against inflation and currency depreciation. Over time, paper currencies tend to lose value due to inflation, excessive money printing, and economic instability. Gold, on the other hand, has maintained its purchasing power for centuries. This makes it an attractive option for those looking to protect their wealth rather than grow it rapidly. When inflation rises, or when there is uncertainty in the economy, gold often holds its value or even increases, helping investors preserve their buying power. Long-term investors typically view gold as a form of financial insurance. They are less concerned with short-term price fluctuations and more focused on long-term stability. For such investors, market dips often present buying opportunities rather than reasons to panic. When gold prices fall due to temporary factors such as interest rate hikes or short-term economic optimism, long-term holders may see it as a chance to accumulate more gold at a lower price. Over time, as inflation continues and currencies weaken, the value of gold tends to recover and grow. Another advantage of holding gold long-term is diversification. A well-balanced investment portfolio usually includes a mix of assets such as stocks, bonds, real estate, and gold. Gold often moves in the opposite direction of stocks, meaning it can help reduce overall portfolio risk. When stock markets decline due to economic or political stress, gold often rises, providing stability during turbulent times. This makes gold an essential asset for conservative investors or those nearing retirement who want to protect their savings. However, gold is not always the best choice for short-term trading unless the investor understands market trends well. Short-term traders focus on price movements rather than long-term value. For them, timing is critical. Gold prices are influenced by several factors, including interest rates, US dollar strength, inflation data, central bank policies, and geopolitical events. A sudden change in any of these can cause sharp price movements in gold. Interest rates play a major role in short-term gold trading. When interest rates rise, gold often becomes less attractive because investors can earn higher returns from interest-bearing assets such as bonds or savings accounts. As a result, gold prices may fall. On the other hand, when interest rates are low or expected to decrease, gold becomes more appealing and prices often rise. Short-term traders closely monitor central bank decisions, especially those of the U.S. Federal Reserve, to anticipate gold price movements. The strength of the U.S. dollar also has a direct impact on gold prices. Since gold is priced in dollars, a stronger dollar makes gold more expensive for foreign buyers, reducing demand and pushing prices down. Conversely, when the dollar weakens, gold becomes cheaper globally, increasing demand and driving prices higher. Short-term traders often track currency trends to identify buying or selling opportunities in the gold market. Market sentiment and global events also influence short-term gold prices. Political tensions, wars, financial crises, or unexpected economic data can cause sudden spikes in demand for gold. In such situations, prices may rise sharply within a short period. Experienced traders often take advantage of these price movements by selling during spikes and buying again during corrections. However, this strategy requires careful analysis, discipline, and risk management. Timing is everything in short-term gold trading. Buying at the peak of a price rally can lead to losses if the market corrects soon after. Similarly, selling too early can mean missing out on further gains. This is why short-term traders rely heavily on technical analysis, market indicators, and news trends. They closely watch support and resistance levels, moving averages, and trading volumes to make informed decisions. While short-term trading offers the potential for quick profits, it also carries higher risk. Gold prices can be volatile, and sudden market shifts can result in losses if trades are not managed properly. Emotional decisions, such as panic selling or chasing rising prices, often lead to poor outcomes. Therefore, short-term trading is generally better suited for experienced investors who understand market behavior and can manage risk effectively. For many investors, a balanced approach works best. This involves holding a portion of gold as a long-term investment while occasionally taking advantage of short-term price movements. Such a strategy allows investors to benefit from gold's stability while also capturing opportunities created by market fluctuations. The key is to align gold investments with overall financial goals, risk tolerance, and time horizon. In conclusion, the decision to buy or sell gold depends largely on your investment objective. Long-term investors benefit from gold's ability to protect against inflation, currency weakness, and economic uncertainty, making it a reliable store of value. Short-term traders, on the other hand, must carefully monitor interest rates, currency trends, and market conditions to time their trades effectively. While gold may not always deliver fast profits, its role as a safe haven and wealth preserver makes it a valuable asset in both long-term and strategic investment plans. Understanding your goals and market conditions is the key to making smart decisions when investing in gold.